Good day and welcome to this presentation on leases. We are still dealing with the lessor. This is part E where we will now focus on the tax when dealing with finance leases as well as disclosure. If we have a look at the tax of a lease transaction from the lessor's perspective, as with lessees, there are two scenarios that exist. We have a suspensive sale agreement in terms of an installment credit agreement, Part A of the VAT Act, or we could have a finance or rental agreement in terms of an installment credit agreement, Part B of the VAT Act. Now, if we look at our suspensive sale agreement, this is where ownership is transferred to the lessee for tax purposes. This means that the lessor would not be able to claim wear and tear allowances on the cost of the asset. But as with lessees, this is not examinable on third year. When dealing with a finance or rental agreement, for tax purposes, ownership is not transferred to the lessee, and therefore the lessee may claim wear and tear allowances on the leased asset as if they are the owner of that asset. The lessor will be taxed on the full installment, in other words, interest and capital that is due and payable. And then very important to note, there is a Section 23A limitation. Now this limitation applies to wear and tear allowances that are granted for machinery, plants, aircraft and ships. And basically those allowances may not exceed the taxable income derived from rental income, in other words your lease installment. So if the wear and tear allowances are higher than your rental income, they would have to be carried over to the next tax year. It is also important to take note of any stipulations of Section 12C of the Income Tax Act when it comes to lessors. So in this example, we are going to use the same example as we used in Part D, except we are just going to change the information slightly to say that TikTok entered into a lease agreement with Talk Limited to lease a machine. Now, the reason we're doing this is because we want to address a different type of tax treatment to specifically address the machine. So the other information that we've added is that the accounting profit before tax of Talk Limited after taking the above lease into account was 305,000 Rand for the year ended 31 December 2018. The normal SA tax rate is 28% and the deferred tax liability balance as at 1 January 2018 was 39,000 Rand. The only temporary differences are those that may arise from the leased assets. A tax deduction of 40% is granted for the machine during the first year and 20% for the remaining 3 years, not a portion for part of a year. The lease transaction is a finance agreement in terms of an installment credit agreement, which is Part B of the VAT Act. Now, the required states that you need to calculate the current tax expense and deferred tax, but using the balance sheet approach of Talk Limited for the year ended 31 December 2018. So originally when we did this example in Part D, we calculated the interest rate implicit in the lease to be 12.957%, and we calculated the gross investment in the lease to be 700,000 and the net investment in the lease was 508,000 Rand. Then the other calculations, which we also have from Part D that we've already worked through, is our amortization table that we prepared using the net investment in the lease amount being 508,000 Rand. We accounted for interest at the interest rate implicit in the lease rate being 12.957%. Then there was no depreciation for the current year as the lease was entered into at the beginning of the current financial year, so there was no depreciation. We calculated the disposal amount being 560,000, which resulted in a loss on the sale of asset being 60,000 Rand. So we pretty much have all the transactions that affect a lease transaction, and we are able to now do the current tax and deferred tax calculations based on the information we have. However, as you can recall, we are dealing with a lessor,
And for tax purposes, ownership of this asset has not been transferred to the lessee, which means that the lessor is going to claim the wear and tear allowances on the asset. So therefore, we still need to know what is our tax base as well as what is our wear and tear allowance for the current financial year. So if we calculate our wear and tear allowance, we will start with the cost price being 700,000 Rand. Then this asset was originally brought into use in the 2017 financial year. And in the 2017 financial year, TOC Limited was entitled to a wear and tear allowance of 40% of the cost, which means that in the 2017 financial year, for tax purposes, 280,000 Rand could be claimed, which means that the tax base as at 31 December 2017 was 420,000 Rand. We are, however, dealing with the 2018 financial year, and therefore the information told us that for the remaining 3 years, that TOC Limited would be entitled to a 20% deduction per year, and it's not a portion for a portion of the year. So that means that the wear and tear allowance for 2018 will be 700,000 multiplied by 28%, which is 140,000 Rand. So now this is the year that the lease was entered into, was our 2018 financial year, which means now we need to start watching out for the Section 23A limitation, which says that your wear and tear allowance is not allowed or cannot exceed your installment. If it does exceed your installment, the wear and tear allowance is capped to the installment amount. So in this case, our installment is 150,000. Our wear and tear allowance is 140, which means our installment is still higher than our wear and tear, and therefore we can claim the full wear and tear allowance for 2018. If we deduct our 2018 wear and tear allowance from our tax base, as at 31 December 2017, that gives us our tax base as at 31 December 2018 being 280,000. In other words, this represents the amount that will be deductible in future. Right, so if we have a look at our current tax expense, then you can see your current tax expense as your statement of profit or loss for both accounting and tax purposes, where you start off with accounting profit or loss and you end off with your tax profit or loss. Your deferred tax can be seen as your statement of financial position, and your carrying amount would represent your accounting standard of financial position, whereas your tax base represents your tax statement of financial position. So the starting point to any current tax expense calculation is your accounting profit, your final accounting profit before tax, which in this case is 305,000, because we've been told that the accounting profit before tax is 305,000 after the lease transactions have been accounted for, so we know it's our final one. Then we need to take into account any temporary differences that may be arising from due to a difference in treatment of accounting and tax. So the first one we have is the loss on sale of asset. Now remember, for accounting purposes, you've recognized a loss on the sale of asset. That loss on sale of asset was deducted when calculating accounting profit. For tax, however, remember ownership has remained with the lessor. So in tax purposes, there is no loss on sale of asset because no asset was sold, and therefore we need to add that loss back. The next item we have is finance income. So for accounting purposes, we only account for finance income. Where tax purposes, the full installment is taxable. So what we do when we're doing our current tax calculation is we will now deduct our finance income, because remember we originally added it when calculating our accounting profit. So we want to take it out. So we're going to deduct our finance income, and for the year ended 31 December 2018, the interest was 65,819. So now we will deduct it. We do this, and later we are going to actually add in the full installment. So the interest will still come in, but it's going to come in with a full installment. Next, we have our wear and tear allowance, which we've calculated to be 140,000, because remember the lessor is able to claim the wear and tear allowance. Next, we have the commission. Now, remember that for tax purposes, the commission that was paid to enter into this lease agreement would be deductible for tax purposes. For accounting purposes, we've actually added it to the net investment in the lease, which means that nowhere did that commission actually affect our accounting profit. So we've never deducted commission from accounting profit, but for tax purposes, we need to deduct it. So now we're going to deduct 8,000 Rand commission. And the last item we have is our installment amount, our lease installment of 150,000 that is taxable. Because we are the lessor and ownership has not been transferred, the full installment is taxable, being 150,000 Rand. If we add all our temporary differences up together, we get a temporary difference amount of minus 3,819 Rand, and this gives us a taxable income of 301,181 Rand. Tax at 28% would give us an amount of 84,331. So that's our current tax expense done. Now if we have a look at our deferred tax from our balance sheet approach, we were told that the deferred tax liability as at 31 December 2017 was 39,000 Rand. Now when you are doing a question, you do not have to go do the line item for the machine as I've done here. This is purely just to show you how that 39,000 was obtained. But so you could just include the 39,000 Rand balance given, as well as also go calculate the temporary difference so that you have your temporary difference and you have your deferred tax amount. Okay. If we have a look at our current year end being 31 December 2018, we still have a machine in terms of tax, but for accounting purposes, we no longer have a machine. Remember, we've taken that machine out. We've disposed of that machine. So according to our statement of financial position for accounting purposes, we have a 0 for the machine. But for tax, on the other hand, we still own this machine. So we have a tax base for this machine, which we've calculated to be 280,000. This results in a temporary difference of 280,000 and a deferred tax at 28% being 78,000 Rand. Next, if we look at our net investment in the lease, again, we are looking at the carrying amount. So this is the balance according to our accounting statement of financial position. And the balance according to our statement of financial position for accounting will be the amounts at 31 December 2018 being 423,819, because this is the amount that is still owed to us on our net investment in the lease. So that's our carrying amount. The tax base for tax purposes is going to, remember, we are now dealing with an asset. We are dealing with a net investment in the lease, which is an asset for the lessor, which means the tax base is amounts that are deductible in future. Now, of that 423,819, is any of that deductible in future? No, unfortunately not. It's all taxable, and therefore our tax base is 0, as there's nothing that will be deductible in future. And that means that the temporary difference is 423,819. The deferred tax at 28% on that is 118,669 Rand. So that will result in a balance at 31 December 2018 being 143,819, which is the 280,000, which is deducted from the 423,819. And that temporary difference results in a deferred tax at 28% being 40,669, which is a liability. So as our liability has increased, we were sitting with a liability, we still have a liability, and our liability has increased, which means that we're going to have a movement in our deferred tax be negative, which means we're going to have a minus 1,669 Rand movement because we've had an increase in our liability. And the temporary difference movement is 3,819, which agrees to our statement, our current tax expense temporary difference amount. But again, as you can see, the signs are opposite, but it makes sense as we're dealing from different sides. We're dealing with debits and credits, so they have to be opposite. So if we have a look at the disclosure for a lessor when it comes to a finance lease, IFRS 16 requires a lessor to, in a tabular format, to disclose the selling profit or loss of the manufacturer or dealer lessor, or if we're dealing with a normal lessor, to disclose the profit or loss on sale of asset. The finance income must also be disclosed, and any income relating to variable lease payments that are not included in the measurement of the net investment in the lease must also be disclosed. Then a maturity analysis must be disclosed, and in this maturity, it must be clear what are the undiscounted lease payments, unearned finance income, and that must be reconciled to the net investment in the lease, as well as include the unguaranteed residual value. And the first 5 years of the maturity analysis need to be shown individually, after which they need to be grouped together. The next item is a qualitative and quantitative explanations of significant changes in the carrying amount of the net investment in the lease, which is pretty much a reconciliation between what is the opening balance of your net investment in the lease and how did you get to the closing balance at year end. Then there are some additional qualitative and quantitative disclosures that may apply, and these include things such as the nature of the lessor's leasing activities, how the lessor manages the risks associated with any rights that it retains in underlying assets, as well as unguaranteed residual values, and then also to disclose risk management strategy. Now, very important, do not forget about disclosure that is required by other standards. For example, do not forget about your profit or loss, your profit before tax note, because if you are, for example, a normal lessor, the depreciation up until when the lease is entered into needs to be disclosed in profit before tax, as well as your finance income, as well as any profit or loss on sale of asset, or if you are a manufacturer or dealer lessor, you would have to include your selling profit or loss as well in profit before tax. So do not forget about your other disclosure. And also remember, you still have accounting policies as well as your tax notes. But also look out for in the question whether or not you are told to ignore certain notes. So if we now do an example just to show you how the disclosure looks when it comes to the lessor, we're going to use exactly the same example that we've now used for tax, and that has come from Part B. The only thing is we're just going to change the required. So here the required states that we need to disclose the above lease transaction in the notes to the annual financial statements of TOC Limited for the year ended 31 December 2018. Your answer must comply with the International Financial Reporting Standards. Comparative figures, accounting policy, and tax notes are not required. So you know now that you do not need to do comparative figures, as well as we can ignore any accounting policy and tax notes. If you are not told to ignore those notes or the comparative figures, unfortunately, you would have to do it if you've been told to comply with the International Financial Reporting Standards. So if we have a look at our disclosure, we know that TOC Limited is a normal lessor, and therefore we know that first of all we need our profit before tax note, and in our profit before tax note under income we're going to have finance income, and for the expenses we're going to have a loss on sale of asset, as well as if there was any depreciation in the year it would come into this note as well, but in this example there is no depreciation. And again, as we're dealing with a normal lessor, we know that the item that is being leased is a non-current asset, and in this case it was an asset that came from PPE. So there are transactions that affect your PPE note. Remember, you have your disposal of your vehicles, and you have your cost price and your accumulated depreciation, and therefore you are required to do your property, plant and equipment note. So in this case, we have our property, plant and equipment note with a carrying amount at the beginning of the year, cost price, accumulated depreciation, our disposal, and then carrying amount end of the year with cost price and accumulated depreciation. Then we get to the disclosure which IFRS 16 has specifically required that we need to do when it comes to leases, and specifically finance leases for the lessor. And in this case, so we have our net investment in the lease, and the first part of it is our reconciliation of the net investment in finance leases. This is where we will inform the users of any changes in the carrying amount of our net investment in the lease. So it starts with the opening balance, any new leases that have been entered into. Now, as we are in the financial year that this lease was entered into, we would not have an opening balance, but we would have an amount next to new leases entered into. Then you have the line item finance income, lease installments received, and closing balance. And that closing balance should be the closing balance at year end. The next requirement is a maturity analysis of future finance lease installments receivable at reporting date. So here's where we have our reconciliation between our undiscounted lease payments and our net investment in the lease, where we show our users how do the two amounts tie up and what is the unearned finance income for each of the periods. So and then also ending off with our unguaranteed residual values. So just to make sense of it all, again, this is referring to future. So these are all after year end. So none of these payments are going to be those that have occurred within the current financial year or before that. We're only looking after year end when it comes to our maturity analysis. So now that we have our disclosure layout, all that we need to do is go and disclose our amounts in our notes. So if we bring our amortization table forward, then under finance income, we will have to disclose the interest for the year ended 31 December 2018, because that's the year end that we are currently busy with. And so we'll disclose it in our profit before tax note, being 65,819 Rand. Our loss on sale of asset, we calculated to be 60,000 Rand. And as we said, there was no depreciation for the current year, and therefore it's zero. If it's zero, you don't have to write it in the note. I've just included it there so that if you go through the slide again later, that it is something that you see and that you will think of in the exam to remember that you need to include depreciation if you're dealing with a normal lessor. Next, we have the property, plant and equipment note. So here we start off with our cost price being 700,000 Rand. We only used this asset for 1 year, and therefore the accumulated depreciation was 140,000. The carrying amount at the beginning of the year was 560,000. There was no depreciation during the year, and our disposal amount was 560,000 Rand. So as you can see, the carrying amount at the end of the year is zero, which makes sense as we've actually removed this asset now from our property, plant and equipment note. Right, so if we have a look at our net investment in the lease, first we do our reconciliation of net investment in finance leases. As mentioned already, our opening balance is zero because we have no leases or we have no information about any finance leases coming from previous years. And the lease transaction that we are currently busy with was entered into at the beginning of the year on the 1st of January 2018. So if we need our amount for the new leases entered into, it will be 508,000 Rand. The finance income, now this will be finance income for our current financial year. So in other words, finance income that was earned for the year ended 31 December 2018, which is 65,819 Rand. And then we need to deduct any lease installments that were received. So again, if we look at for our year ended 31 December 2018, there was only one lease installment, and therefore we're only going to deduct one lease installment, and that gives us a closing balance of 423,819, which agrees to our amortization table balance at 31 December 2018. Okay, so when looking at our maturity analysis, as already mentioned, our maturity analysis focuses on future finance lease installments, in other words, all installments after year end. So in other words, we're looking at everything after 31 December 2018. So let's include our amortization table to make it easier. And if you are someone who gets confused between the different year ends, especially when you have more than one payment that falls within a year end, or when you have a situation where year end and payment dates don't agree, then it is helpful to draw lines at each year end just so to make it easier for yourself when it comes to the disclosure, so that you know what should be included in which period. So if we have a look at our year end 31 December 2019, we will need to disclose it in our 2019 column, and the payments there's only one payment being 150,000, our interest being 54,912, and the net investment in the lease is 95,088. When we look at the financial year ending 31 December 2020, again, we can see there's only one lease payment, so it's 150,000 Rand. The interest is 42,593 Rand, and that gives us a net investment in the lease of 107,407. Then for the year end 31 December 2021, we have a lease payment of 150,000, but we also have a guaranteed residual value that's paid at the end of the lease. In other words, on 31 December 2021. So that means that our total undiscounted lease payments for the year ended 31 December 2021 is 150,000 plus 100,000 Rand, because this is a guaranteed residual value. So it falls within our normal lease payments. It's only our unguaranteed residual values that will be disclosed separately. Unless, of course, this guaranteed residual value was paid maybe after year end, then it would be included in the next financial year ends column. Okay, but in this case, everything occurred within 31 December 2021. The unearned finance income relating to 31 December 2021 is 28,676 Rand, and that gives us a net investment in the lease amount of 221,324. Okay, so let's for a second think about if this example was actually dealing with a manufacturer dealer lessor who was leasing their inventory. So remember, you only apply the manufacturer dealer lessor leasing rules when they are leasing their inventory. So how would the disclosure change, and would it change at all? Okay, well, let's have a look. As far as the profit before tax note is, Finance income would remain the same because whether you're dealing with a normal lessor or a manufacturer or dealer lessor, you have finance income. However, when you're dealing with a manufacturer dealer lessor, you are not leasing an item from your non-current assets, and therefore there would be no depreciation and there would be no loss on sale of assets. Instead, you would have a selling loss being recognized, or if it's a profit, you would have a selling profit being recognized. But as you would be leasing inventory, there would be no depreciation because you do not depreciate inventory. Okay. Then, if we think of the other note that we included with our normal lessor, we had our property, plant, and equipment note. Now, this would not apply if you were disclosing for a manufacturer or dealer lessor because, again, they are leasing their inventory, and inventory does not come into property, plant, and equipment. So instead, you would maybe need to disclose inventory. The notes on the leases itself, such as your net investment in the finance lease notes, those would remain exactly the same whether or not you are dealing with a manufacturer or dealer lessor or with a normal lessor. So that brings us to the end of this presentation, and we will continue with leases in part F, where we will deal with the lessor, where the lessor has entered into an operating lease. Thank you for watching. Goodbye.